down 67% in 2022. Is Palantir stock a buy for 2023? I'm going to answer that question in this video, so stay tuned. The first thing I'm going to look at to answer that question is overall revenue and revenue growth. Overall revenue in the purple here, 477 million in its most recent quarter, and you can see steady growth going back to before 2020, growing revenue nicely. However, if you look at the quarterly revenue growth number, that's been decelerating considerably for each of its quarters, and it most recently reported disappointing revenue growth of 21.86%. The next thing I want to look at is its operating income, and what you see is steady losses in terms of operating profitability for this company. Of course, it's still in growth mode, so you would expect to see some losses. But what I like to see, and if you're if you're a subscriber, you've been watching my videos, what I like to see with these fast growing companies is to demonstrate some economies in scale, to show decreasing losses as revenue is growing. I don't see that with Palantir here. I just see flatlining operating income. If you ignore this big crash here, just flat operating income going back several quarters. The next thing I want to look at is its cash flow from operations, and thankfully it's been generating positive cash from operations, 47 million in its most recent quarter. And I guess you could say there is some upward trend, but if you exclude the first quarter of growth here, going from there, it's been flat-ish, like its operating income. And if you ask, how can a company generate positive cash from operations and still be losing so much money in terms of operating income? And the answer is that companies like Palantir, or tech companies that have a lot of tech employees, can pay them with stock-based compensation, which is a non-cash expense that allows positive cash from operations even though they're losing money on the bottom line. The next thing I want to look at is Palantir's average diluted shares outstanding, because like I mentioned, they're paying their employees stock-based compensation. So I want to see how much that's diluting shareholders, and it's diluting them by quite a bit. Starting out in 2020, they had about 800 million shares outstanding. They now have almost 2.1 billion shares outstanding. So their shares outstanding have almost tripled, which is not good news for investors. Next thing I want to look at is Palantir's total assets. And looking at their total assets, I see that's been growing from close to 1.5 billion all the way up to 3.32 billion. So nearly twice the assets that they had in 2020. Meanwhile, they're generating just about the same cash flow from operations. They're losing just about the same operating income, and their revenue growth is actually slowing. That's not what I like to see. I like to see companies increasing their revenue off an existing base of assets. I don't want them employing more assets and their revenue growth slowing, right? If you're bringing on more assets into the company, I want you to be making more money because you now have more assets, right? If you were making t-shirts with 5 machines and earning $100 in revenue, and you now bring 10 machines and you're still making $100 in revenue, I'm not going to be happy with that as an investor. If you're making 100 with 10 machines and you now have 20 machines, I want to see you making at least 200, right? I want to see the benefit of those additional 10 machines. I'm not seeing that with Palantir. I'm seeing their total assets doubling, and I'm seeing their revenue not really their revenue growth decreasing, going from the near 50% level down to the 22% level. So this is not what I like to see from an investor's perspective. Finally, I want to look at its valuation, and I'm going to use its price to sales ratio and price to free cash flow. And trading at a price to sales of 6.7, the stock is not cheap. That's an expensive price to sales. It's the cheapest that Palantir has sold for if you look at its history, but you only have a brief history to look at. Relatively speaking, it's not. It's the cheapest you've been able to buy the stock, and also price to free cash flow at 62. Relatively speaking, it's the cheapest you've been able to buy Palantir stock, but it's a price to free cash flow is not cheap in itself. That's an expensive valuation to pay, especially for a company that's not demonstrating, like we saw earlier, that's not demonstrating growth in cash flow from operations. From July of 2020 to July of 2022, I'm not seeing very much growth in cash flow from operations. So why do I want to pay a premium price like 62 times free cash flow for a company that's showing flat-ish revenue cash flow growth? So all in all, to answer the question, is Palantir stock a buy for 2023? I'm going to say no, it's not a buy for 2023. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.